You're right, mate. Yeah, not bad, mate. What's up? Did you know that if you invested £250 a month for 33 years into a simple global index fund, you'd be a millionaire? No, I didn't actually. That's really interesting. But what on earth is an index fund? All right, well, I'm glad you asked. Come into the lab and I'll unpack it all for you. Mate, don't you think the lab is just your spare bedroom? Yeah, of course, but if you could just run with it for this video, that'd be great. Oh, right. Yeah, I get it. To the lab. Right, let's get into it. So to become a millionaire, thankfully you don't need a fairy tale godmother anymore or even to strike it big on the lottery. Any one of us can become wealthy by becoming an index fund investor. Now first off, let's address the elephant in the room. Why is it that we can go through years of schooling and never learn about how to handle our finances? It's a little bit odd, isn't it? We learn about history, science, religion and literature, but the subject of money is conspicuously absent. That's a gap we're going to fill today, starting with the basics of investing in index funds. Now, the word investing might make you feel a bit uneasy. You've probably heard stories about people losing their life savings in some risky venture, or your mate losing all his money on Bitcoin down the pub. But here's the thing, not all investing is created equal. Some methods are like jumping out of a plane without a parachute, while others are more like a scenic car ride. Now, thankfully, index funds falls into the latter category here. For me, they're one of the most safest and straightforward ways to invest, especially for beginners, but equally for more seasoned investors too. So what exactly is an index fund? To understand that, we first need to know what an index is. An index is essentially a measure of a section of the stock market. A great way of understanding it that I really like, remember the days of Top and the Pops? It was the top 100 selling tracks in the UK at the time. Now an index fund is exactly that, but the stock market equivalent. It's the top performing companies in that particular section of the stock market, and indexes can be country, continent, or in some cases global specific. One of the most well-known indexes is the S&P 500, which tracks the 500 largest companies in the United States. When you hear about the stock market is up, people are referring to indexes like the S&P 500. So how's that different to a stock? Well, a stock represents ownership in a single company. If you buy a stock, you're buying a piece of that company. You become a shareholder, you own a share of that company's earnings and assets. But here's the catch though, owning just one stock can be a bit risky. If that company does poorly, then your investments could plummet. This is where index funds come in. Now imagine a basket, but instead of filling it up with fruits or groceries, you're filling it up with tiny pieces of companies. Big ones, small ones, all sorts. An index fund is like buying that one basket. You've not got one item in it, instead you've got a whole basket full of goodies, but you only buy it once. This is what we call diversification, and it acts like a safety net for your money. If one company in your index fund does poorly, others might do well, and that balances things out. One of the most famous index funds is the Vanguard Global Stock Market Index Funds. It's literally made up of the top 5,000 companies in the world, starting with the largest, which is currently Apple, right down to the 5,000, which I have absolutely no idea what that is. Why owning this fund is awesome is if that 5,000 company does actually do poorly, it's simply replaced by the company that's sitting in position 5001. So at any point you own the top 5,000 companies in the world. To put this into context, these are the top 10 companies from 30 years ago. Some names in there you'll know for sure, Walmart, General Motors, Ford, they're all sitting there, but not really what you expected, right? Now if I fast forward this to today, I bet you'll know pretty much all of the top 10. Apple, Tesla, Microsoft, Amazon, essentially all of the big boys are in there, and it's changed a lot. Not one of those companies from 30 years ago currently sits in the current top 10. I wonder what it will look like in 30 years time. But literally, who cares? If I own the S&P 500 for instance, I own the top companies. So I couldn't care less about who's in the top 10, as long as they're outperforming the ones that were there before. Now imagine if I'd have only invested in one stock, Ford let's say. I'd have been seriously outpaced by your Apples and your Microsofts and basically missed the entire rise of technology just by not holding an index fund. Now, Warren Buffett is a name that you might not know, but he's one of the most successful investors ever. A few years ago, he bet that a simple index fund would outperform a group of professionally managed funds over a decade. An investor actually took him on, and he had to actively buy and sell stocks trying to beat simple index fund investing. Guess who won the bet? You got that right. Warren the Bizzle Buffett absolutely smashed it. The index fund literally beat a professional stock picker. So if someone who's made billions through investing vouchers for index funds, I think that's a pretty strong endorsement, don't you think? Now, you might be wondering why not just pick some winning companies and invest in them? Well, picking individual stocks is a bit like betting on a horse race. You could win big. You could also lose big too. Index funds are more like betting on the entire race. You're not putting all your hopes on a single horse. This is what we call risk management, and it's crucial for long-term investment success. So let's have a little look at the performance of the S&P 500 so you can see what I'm talking about here. This goes right back to the 1950s, and you can see three of the largest crashes, including the Black Monday, the dot-com bubble as well, which was where everyone went a bit crazy when the internet started becoming a thing. Not much has changed there, right? There's also the financial crash that we had in 2008 too. Now you can see why holding stocks for the long term really pays off. If you bought 30 years ago today in 1992, you'd have seen two massive crashes, but by now, you'd be doing pretty damn well. Next up, I want to show you why a buy, hold and accumulate strategy is so important here, especially when you're investing in index funds. If the stock market crashes, you don't want to take your money out. In fact, the years after the stock market crashes are often the best performing years, as a recovery is simply underway. If you stopped buying each month because it crashed, you'd have missed a lot of the gains. Here is a chart that shows if you missed the top 10 performing days by taking your money out at the wrong time. This chart is essentially starting with $10,000. And if you miss the 10 best performing days in the stock market, you'd have around $74,000. But if you'd have held on, you'd have over $150,000, which is just over double. So buying and holding index funds wins if we're looking at the history books here. Even better is if you can dollar cost average into the market every month. This basically means investing like clockwork every month, no matter what is happening. Over time, what you do is you buy at different points, and that averages out over time to give you some nice gains. It also lowers your risk, because if you invest a lump sum, you're basically buying at that one point. If that's missed time, you might have to wait longer for the stock market to come back, especially if it's behaved badly right after. So what is the best place to invest in an index fund? For those of us in the UK, we have a couple of options. You can use an individual savings account or an ISA, which is a tax-free way to invest. With an ISA, you get £20,000 tax-free contributions every tax year, and your profits, interest and dividend payments are free from what's known as capital gains tax. There is also the self-invested personal pension, or SIP as it's also known, which is another tax-efficient option, but it's really geared towards retirement. You do also have a GIA or a general investment account too, but just remember that that is subject to capital gains tax. In the US, you have the 401k or the Roth IRA, similar to the ISA in terms of access, but it's very different in terms of tax benefits. So the big question now is, how much should I invest in an index fund? The answer is whatever you can consistently afford. If you can only spare £50 a month, don't underestimate the power of that £50. This is where the magic of compound interest comes into play over time. So what exactly is that compound interest in simple terms? Basically, it's interest on interest. Let's break it down for you. Imagine you had £50 to invest this month. If you earned 8% on an annual return rate, by the end of the year you'd have £54. That's the original £50 plus £4 in interest. Now here's where it gets interesting. Next year you'd earn interest not just on the original £50, but on the £4 of interest that you earned too. So you're earning interest on a total of £54. Now this might not seem much at first, but over time this really snowballs. Your money starts to grow faster and faster, almost like a snowball running down a hill, gathering more snow as it goes. That is the power of compound interest. Let's say you invest £50 a month on that 8% annual return rate that we were talking about. In 33 years, you'd have £100,000. You'd invested £19,800 of your own money, but thanks to compound interest, you'd have £80,200 in interest alone. That is the power of starting small and thinking big. The beauty of index funds is they're incredibly low maintenance, making them perfect for every type of investor. Whether you're a busy professional, a stay-at-home parent, or even a student, index funds offer a way to invest without you having to require to be the new Wolf of Wall Street. So here's how it works. You can set up a monthly direct debit for an amount that you're comfortable with, be it £50, £250 or more, it really doesn't matter. Once that's done, you can essentially forget about it. This is a set it and forget it approach. It's what makes index funds so appealing to so many people. You don't have to spend hours every day monitoring stock prices or reading the financial news. The index fund does the heavy lifting for you. But it's crucial to remember that this is a long-term strategy. While it's tempting to dream about getting rich quick, index fund investing is all about building wealth steadily over time. It's about participating in the growth of the entire market rather than trying to pick that new hot stock. So if you're someone who wants a piece of the stock market action but doesn't actually want to spend your days analyzing charts, financial statements, reading through reports, index funds could be perfect for you. Some of the best index funds right now are created by Vanguard. The founder John Bogle was considered the godfather of index funds. He literally came up with them. But you can do well with any index fund equivalent. It doesn't have to be Vanguard. There's other index funds out there by BlackRock, also known as iShares, and brands like Fidelity too. There's honestly loads of them. Essentially what you're looking for is an index fund tracker. If you're unsure, ask your provider to point you in the right direction. So there you have it, guys. Here is your beginner's guide to index funds. Hopefully you've got it sussed by now. And if you do have any comments, just drop them in the comments box below and I'll get back to you with an answer. Look, a quick shameless plug here though. The Money Gains podcast is where we do a weekly podcast. We interview the top minds in the financial industry. There's a back catalogue of episodes available right now on our YouTube channel. So hit subscribe and get them served up to your feed every single week. But wait, don't go anywhere, guys. If you do want to hear more about index funds, check out our podcast episode with Jordan from Save and Invest UK. There's a link coming up just now and I'll see you soon. Cheers.